There is an assumption most people in this space have never really questioned. The story goes that Chainlink is Ethereum's Oracle project, born on Ethereum, grown on Ethereum, dependent on Ethereum, which puts Chainlink in the supporting role and never really the headline. And I want to challenge that, because when you look at how the numbers exactly break down and where Chainlink is moving as a business, the dependency runs in a direction you might not expect. Ethereum's DeFi ecosystem relies on Chainlink structurally at a level most holders of either asset haven't fully internalized. And at the same time, Chainlink has been building itself into infrastructure that doesn't need any single chain to stay relevant. Those two things together tell a very different story than the one most people assume. So let's start with what's happening on Ethereum right now. As of today, Ethereum leads DeFi with around $45.5 billion in total value locked, confirmed on DeFi Llama. But its market share has dropped from over 63% a year ago to roughly 53 to 54% right now. So that means capital is moving. Solana, Base Arbitrum, and a handful of others are pulling serious liquidity. Ethereum still has the deepest hub for blue chip lending and stablecoins, and that matters, but the depth alone doesn't protect you if the foundation data layer underneath breaks. That data layer has one dominant provider, and it's been Chainlink for long enough that most protocols stop thinking about the alternative. Chainlink's price feeds have secured over 83% of all Oracle supported value on Ethereum. On Base, Ethereum's most prominent layer 2, it's close to 100%. Across Ethereum-based lending and derivative platforms, Chainlink serves the overwhelming majority of major protocols. Right now, Chainlink's total value secured sits at $32.7 billion. That's the value of assets where Chainlink's Oracle infrastructure is the last line of defense. If the feeds fail, those positions don't get liquidated properly. Bad debt accumulates, and the mechanism that keeps these protocols solvent breaks down. The clearest example is Aave, the largest lending protocol in DeFi, runs almost entirely on Chainlink feeds for collateral valuation, borrowing limits, and liquidations. Aave adopted Chainlink's feeds specifically to power its new V4 markets. That's a protocol choosing to go further into the Chainlink dependency and not really looking for alternatives. The same pattern runs through Compound, Maker, Synthetics, and most derivative platforms on the network. The reason this happens isn't just that Chainlink was early, it's that the alternative, protocol sourcing price data from a single exchange or a thin on-chain pool, is how you get flash loan exploits. It's how an attacker manipulates a market for 30 seconds and drains a full lending pool. Chainlink's decentralized node model, aggregating data across multiple independent sources, was the exact solution to an expensive problem the ecosystem kept running into. The protocols that tried to go around it found out why this existed. So when people talk about Ethereum's DeFi mode, they're not wrong, but that mode is partially built on Chainlink's rails. If you remove it, you're not looking at a DeFi ecosystem with a gap in it. You're looking at a system that can't price its own assets safely. Let's flip the question. How much does Chainlink actually need Ethereum? If you look at the revenue trajectory, because this is where the story gets really interesting, through most of 2024 and into early 2025, Chainlink's quarterly protocol revenue was in the range of a few hundreds of thousands of dollars. Q2 last year was around $600,000. By Q3, it was almost $9.4 million. By Q4, 15.7, and Q1 this year, 15.9 million. The business model started actually working, and it's working because Chainlink's revenue is now spread across a much larger surface area than just Ethereum. CCIP is a core of that surface area expansion. It's live on 35 chains with 76 cross-chain tokens, with 78 networks connected on mainnet covering 228 tokens and $18.6 billion in cumulative transfer volume. What started as a cross-chain messaging tool has grown into a plumbing that the whole industry is standardizing around. And the adoption it's seeing now is actually institutional production use at the highest level. In Q1 alone, Amundi, Europe's largest asset manager with 2.3 trillion euros under management, launched a tokenized mutual fund with Spyco, which was powered by Chainlink. It became the fastest growing tokenized fund in the world, hitting $400 million in AUM in just 3 weeks. And the Bank of England selected Chainlink to participate in its synchronization lab, supporting settlement between central bank money and of course on-chain securities. And then you have Visa, ANZ, China AMC, and Fidelity International, who completed a cross-border settlement solution under the Hong Kong Monetary Authorities program, powered by Chainlink. Robinhood named Chainlink as the Oracle platform for Robinhood Chain. So, bunch of big news that just keeps piling up on the already strong foundation that Chainlink has. So what were those institutions actually doing? They were not picking a chain, they were picking Chainlink specifically, and the chain was just an afterthought. The institutions choosing to build on this infrastructure are not making a bet on Ethereum's continued dominance. They're making a bet on Chainlink specifically, its data standards, its interoperability layer, and increasingly on its own compliance credentials. This first quarter, Dell would complete a SOC2 Type 2 examination for both CCIP and Chainlink's data feeds. I've covered this in one of my previous videos, and now Chainlink is the only Oracle and interoperability platform that meets SOC2 Type 2, Type 1, and ISO 27001 certification, the security standard that institutional procurement teams actually require. And of course, regulatory piece, the US SEC and CFTC issued a joint interpretation in this quarter as well, officially classifying the Link token as a digital commodity. For institutional players who've been sitting on the sidelines waiting for clarity, that's already a very meaningful signal. It puts Chainlink in a different legal category than most crypto assets, and it removes a layer of uncertainty that previously made it harder to justify building production systems on its infrastructure. So there's a comparison that fits here, even if it's been used before. TCP/IP doesn't care whether you're on Windows or Linux. It's the communication layer that lets all of them talk to each other, and it doesn't own its existence to any other or to any one operating system. It's the position that Chainlink is building towards, and not just an oracle for Ethereum, but the data and interoperability infrastructure for the entire on-chain economy. The chain underneath is increasingly besides the point. And then quickly on point of competition, yes, PIF has real traction on Solana, and that's worth acknowledging, but Chainlink's total value secured is 8 to 9 times that of its nearest competitor across the entire industry. So when you look at which existing protocols consistently choose Chainlink for their most critical functions, like Aave going deeper into V4, Robinhood building its entire chain across Chainlink standard, and Amundi launching the world's fastest growing tokenized fund on it. Yeah, that's just revealed preference. I mean, trust in Oracle infrastructure accumulates over years of not getting exploited. It just doesn't transfer that easily. So here's where that leaves everything. Ethereum's DeFi ecosystem, $45.5 billion of locked value, runs on Chainlink's data infrastructure to a degree that's rarely stated clearly. At the same time, Chainlink has also built itself into a position where its revenue, its institutional relationships, and its expanding network span far beyond Ethereum's fortunes. Chainlink can route around Ethereum if it needs to, and increasingly it is. It's pulling Chainlink's data feeds out, and replacing them overnight is a different conversation entirely. That asymmetry is what the title is pointing at. It's not a knock on Ethereum, it's a more accurate picture of who actually depends on who in 2026. So what do you think? Do you think this gap is widening further, or does Ethereum's liquidity depth keep it more balanced than making it sound? If you think I'm wrong here, let me know, and definitely drop it in the comments. Please subscribe, putting these videos out every week. Thank you. Cheers. Bye-bye.